All right, so I know we're going to have a slow trickle back in after lunch, but I want to go ahead and get us started with our next panel, which is on U.S. industrial policy, past, present, and future. I'm Lori Bennear. I am the Standback Dean of the Nicholas School of the Environment here at Duke University, and it's my pleasure to welcome these amazing panelists here. We have Kristina Costa, Nat Keohane, Taite McDonald, and Peter Smith. So I thought I would just, before we get into questions, just ask each of you to do like a 1 or 2 sentence introduction, who you are, what your company does, and why you're on this panel. Kristina.
Hi, Hi everyone. Is this on? Yeah. Yes, okay. Kristina Costa, citizen, but until January 17th, 2025, I ran Inflation Reduction Act implementation as John Podesta's deputy in the White House. Nat.
Thanks, Kristina. Thanks, Lori. Nat Keohane. I'm the president of the Center for Climate and Energy Solutions, or C2ES. We've been around for over 25 years, starting life as the Pew Center. We're a DC-based climate NGO that works on international and national climate policy. And of particular relevance, we spend a lot of time bringing businesses up to the Hill to make the case for effective and ambitious climate policy and the economic and business case for that. And you'll hear more about that in a bit.
Hello, everyone. Taite McDonald, lawyer by training, partner at Holland & Knight, but I run a pretty robust energy transition funding and finance practice. My practice has helped negotiate, lobby, write applications for, and now save about $25 billion of projects in the last 2 years.
Hi, everyone. Peter Smith. I work at EQT, which is a global asset manager. We manage about $270 billion across private equity and real assets. I sit on the infrastructure investment team, and I'm helping raise our transition infrastructure fund.
Great, and thank you to the organizers for inviting all of us to join you today, and thanks all of you for coming back after lunch to listen to this great panel. So why industrial policy in a day-long conference essentially on the energy transition? So during the Biden administration, several of the critical climate action bills, including the Inflation Reduction Act, which Kristina was critically a part of, combine decarbonization with efforts to bring manufacturing back to the United States with additional credits for projects that had particular percentage of domestically produced components and other things. And so as we're transitioning to the new administration, there continues to be interest in reshoring American manufacturing jobs and other things that typically among economists we think of as industrial policy. So this panel is going to go into some of that. And so we'll start with Kristina. In light of recent legislation, the bill, the CHIPS Act, the IRA, how do you assess the current state of U.S. industrial policy? And do you see impending tariffs impacting the extent to which the private sector invests in advancing industrial policy?
Yeah,
as a citizen, not as
I'm free, so I can say anything. Well, so let's go back to the heady days of 2.5 months ago and talk about where we were, and then we can talk about where we are. And actually, I'll go a tick further back, which is why did we bake so much industrial policy into what was fundamentally a climate bill? And it is largely a recognition of the fact that the United States, for many, many years now, and particularly in sort of the last 20, 30 years, has enjoyed an enormous economic advantage on the world stage, largely as a result, and this is going to be a weird thing for a Democrat who works on climate policy to say, largely as a result of gangbusters domestic production of oil and gas. But at the same time, China, in particular, had been making determined investments to reduce their own dependence on imports of oil and gas, including from the United States as well as from other countries. And so if you looked ahead, if you want a clean energy transition, you can't just subsidize the clean energy technologies, you also need to support manufacture and development of those clean energy technologies domestically if you don't just want to deepen a dependence on a foreign country for those inputs and for that energy supply. And so that's like the fundamental theory behind why the IRA in particular, but also the bipartisan infrastructure law is investing kind of on both sides of that equation. When the Biden-Harris administration left office, if we just look at the scoreboard, under Inflation Reduction Act implementation, we had awarded $107 billion in federal resources to clean energy manufacturing development projects to capitalize new green banks, to invest further through the Greenhouse Gas Reduction Fund, to help subsidize farmers, to incorporate climate smart practices. We had obligated $98 billion of those dollars. This is an important distinction. An obligation means that there's a signed contract between the federal government and a counterparty that is supposed to hold both of those parties accountable for actually spending the money in accordance with the contract. Of course, as we've seen, this administration has decided to throw the full faith and credit of the United States into complete disarray around this. And we had issued guidance on 23 clean energy tax incentives, 96 unique guidance documents from our friends at the Department of Treasury and the Internal Revenue Service, which had prompted at least $450 billion in just 2.5 years in private sector investment in clean energy manufacturing, clean energy deployment. That was a pretty good situation, I think. And these guys could have kept hitting the easy button, the easy manufacturing button, and said, yes, more jobs, more manufacturing, more investment. 74% of those clean energy manufacturing investments from the private sector, by the way, in Republican states and in Republican districts. And instead, they decided to do whatever the hell it is that they're doing and throw the entire market, not just on the clean energy side, but the entire market into complete and utter free fall. And I think
You're going to stop at that.
I'm going to stop at that.
So that's where we were to where we are now. And Nat and Tate are going to talk a little bit about where things are now.
So I thought I'd talk a little bit about the congressional side of it. So as Kristina laid out, there were two big pieces, and many folks in the audience will know, but maybe not everyone. There were two big pieces to the Inflation Reduction Act. And if you want to sort of go back further to like the agenda over the past several years, part of that was the grants that Kristina talked about, and Tate has been really centrally involved in those, so we'll let her speak to that. But the other part were tax credits, and David Crane, for those of you who were here in the last morning session, referred to that a little bit. He talked about that with Brian Murray. So I want to sort of pick up the story. There's part of sort of where were we 2 weeks ago, and sort of what was that theory of change, and I want to talk a little bit about I think where we are in Congress, and then, but you know, Kristina and I were saying beforehand we can't ignore the sort of elephant in the room. I think David spoke to it well, so I have a big asterisk coming at the end. But as of 2 weeks ago, when we were thinking about this panel and what we were going to say, here's where I would have sort of handicapped it. About 2/3 of the IRA, the Inflation Reduction Act, was scored at just under $300 billion, was the last final score, meaning that was the estimated cost to the U.S. Treasury. About 2/3 of that, give or take, were the tax credits. The rest were grant money. Those tax credits, there are a couple things important to know about them. They are open-ended in the sense that the amount of money that gets spent depends on how many people, for the most part, how many companies take them up. There's also a whole alphabet soup of what they cover, and so there are lots of different clean energy manufacturing and deployment credits out there to really help to jumpstart investment in clean energy, not only in electricity generation, but also in hydrogen, sustainable fuels, in nuclear, in clean energy manufacturing, in electric cars and electric vehicle chargers and so on. Each of them has its own letter. It's all very fun. We could spend hours talking about the difference between U and V and X. But the point is lots of money going into those tax credits, and as David said this morning, that's not the only thing that a CEO is going to look at in making investments, but they can be the difference between a project penciling out or not. And so really important for driving investment going forward. So as of 2 weeks ago, here's what I would have said. The Congress is considering, as people know, Congress is considering reconciliation legislation to look at the budget. Trump, as folks will remember, put in place very large tax cuts in his first term. Those are set to expire under the current law from 2017. And so Congress is looking for lots of, essentially trillions of dollars of savings that it can use to offset that. There's some budget arcana, but that's the basic story. So these credits, which were scored originally as being hundreds of billions of dollars and may now be more than that because they're open-ended, these are one area where Congress is looking to cut. So as of 2 weeks ago, what I basically would have said is, look, there's a lot to play for here. Some of those credits are quite robust and I think very safe. So if we want to give an example with the alphabet soup, there's a credit for carbon capture and storage, 45Q. That's been around for a long time. A lot of oil and gas companies, we heard about ExxonMobil. There's a lot of companies in the South and in Republican states and oil and gas companies that are using that credit. That feels pretty secure. There's electric vehicle credits that are consumer credits. It's harder to tell a story about the economic boom that's going to come from that. EVs maybe are more ideological. Those maybe are at high risk. And right in the middle, we think there are two of the credits that matter the most. There's the credits that support clean energy generation, clean electricity generation, which are a new version of the tax credits that have been around for a while. But instead of having credits that are specific to wind and solar and have to be renewed every 2 years, there would be a whole set of credits that were technology neutral, applied to all zero carbon generation. This is something we bugged Kristina while she was in the White House. We took our companies up to bug her about that guidance. Great job by the Biden administration. That feels like something that would really power, if you were in an energy emergency, would power lots of clean energy, clean electricity. Also another one for clean energy manufacturing. As of 2 weeks ago, I would have said, we think we're in pretty good shape. It's an uphill battle to preserve all of that, but you can make the case in a lot of congressional districts, including a lot of Republican districts, that those credits are responsible for jobs, for investment. Kristina mentioned that. We have a map. You can go on a map. You can find out all the investment that's happening. And congressional, members of Congress are responsive to that. So that's where we were a couple weeks ago. I would have said, look, it's a tough fight. We've got to fight through reconciliation, but I think we have a good chance. 21 Republican congressmen signed a letter a couple weeks ago saying they were on board. Now the big asterisk, and then I'll hand it over to Tate, but the big asterisk is, I think, what David said. In a world in which the US is putting tariffs, massive tariffs on every country, I guess a couple things happen. One is, as David said, there's huge amounts of unpredictability. So I don't think we know enough at all to know what's the direction of travel. And that also means that even if we preserve these tax credits, we're not likely to get that clean energy boom in the near term because of all that other uncertainty, although it's still important to preserve them. The other is that we could be entering a massive recession as a result, and that kind of upends everything. So where I'll end is, like, the theory of the case is, if we're successful with this, we can see a clean energy boom. That could, I think, fundamentally lay the groundwork for much better, more productive clean energy politics in this country if you had a clean energy boom under a Republican administration. But we've kind of thrown all that out the window with the past couple of days, and we'll have to see what happens with the economy.
Great. Tate, on that happy note.
On that happy note. So I think the way I'll talk about this quickly is the nice thing about where I sit in the industry is our projects are a good litmus test for the broader industry. And so we have about 100 projects that are contracted, are under award, whether they are conditional commitments from the Loan Guarantee Program Office, closed commitments from the Loan Guarantee Office, or every type of contract, you name it, we've dealt with it in some case in clean energy. And depending on the stage of the contract, the type of the contract, all are at risk in different ways. How do you sum that up quickly in a presentation like this today? I would say we are at about, what's nice about having signed contracts is the fact that they are still signed contracts, and we do have a Secretary of Energy that says he will follow the law. There are some areas, especially with the new termination for convenience clause, there are some areas that are up for negotiation. However, what Nat said, it rings true for these projects that have grants and loans, just like the tax credits, a lot are in red states, creating jobs in red states. So when you compile all that together, it makes it not terrible to go to Republicans and say, can you save these projects, or find ways for Republicans to weigh in our favor of our projects. So we did that, Trump won. We're doing that again. Do you have to get a little creative sometimes? Like, try to not only look at jobs in a state, but then see who on the board may have been friends with Donald and is at Mar-a-Lago? Like, you got to get creative here. But we can do it, and we can usually find a path forward to make this make these projects more attractive to a Republican administration. Of course, you cannot do that with offshore wind right now, so we're not even trying that. But the bottom line here is that when you take all of that together, I would say we probably had about 20% of projects like really say, we are not moving forward in the market. And all of this actually started to happen for us in like October, November with election uncertainty. And then where do we stand now, especially with tariffs? And I'm gonna pass it over here. But where we stand right now and what's important is the market is going to be increasingly fragile in the investment of the equity. And that's what this comes down to, because you do, as much as we have contracts, we have contractual uncertainty. There are some outs in government contracts, even though these are great projects and I think we can save them, the combination of everything in the market is really what's putting these on edge. So the companies, we do have a lot of companies who have raised their equity before, and we might have a little tax credit uncertainty or a little tariff uncertainty. Those projects we're still gonna see move forward pretty smoothly. Although now we have just a more significant bunch of projects than I was hoping that are still at risk because of equity markets and tariffs, of course, but all that goes to the markets.
Yeah, so Peter, why don't you bring us home on this by talking about how private sector is thinking about investment in this chaos.
Yeah, and I
uncertainty.
It's similar to Nathaniel. Also caveat with 2 weeks ago versus now. But look, when we're looking to invest in infrastructure, these are really long-lived assets, right? And we're looking for market stability and predictability, and then policy stability. But we can talk about ways to mitigate that. And so, because while you may have contracts, you really want to make sure these assets are used and useful. It's kind of a bad day if you have to go back and get your revenue from the contracts, and that's all you're leaning on. It just makes it tougher, and you can go through court and all of that. So we're really looking for market stability. And I think, where we're looking to invest now, there were some questions about what would stay in place in the IRA, and we could take a view on ITCs or PTCs or consumer credits and what the likelihood is that. But what we really want to focus on are investments that have proven unit economics and do not rely on subsidies to really meet the hurdle. Those can be additive, but we don't want to stand fully on the subsidies. And so what you really need to do is zoom down and see. You can't talk about, I don't think, renewable energy generally or EVs generally. You really need to see what the use cases are. And so in renewable energy, I'd say a big focus for us right now, where private markets are looking and can still make a case, are in distributed projects, and particularly those that may be microgrids that have solar plus BESS, and they can deliver energy today where the grid can't at a pretty compelling cost. Because those customers can't wait 7 to 10 years for grid power, so they may be able to pay the premium. I think tariffs make all of this a bit more uncertain, just because you don't know, even if you have supply chains that are in the US, right, but you're competing with imported products, the overall market clearing price will go up. So you don't know, even if you're purchasing from a US purchaser or producer, kind of what your cost of that CapEx is gonna be. So I'd say everything is a bit uncertain now, although if tariffs came into play and were stable, you would look at things like EVs for fleets, where actually the tariffs on a total cost of ownership basis are helpful for EVs because those supply chains are more localized than ICE vehicles. Or things like advanced recycling, where you can then do upcycling and produce, have a circular production within the US.
Great, thank you. So obviously there's a lot of focus at the federal level and industrial policy at the federal level, but we do have other governments, state governments, municipal governments. How can those state and local governments continue this work? What's their interest in industrial policy around clean energy? And does this vary with the maturity of the technology or the scale of the project? Kristina, you want to kick us off?
Yeah, absolutely. I mean, states can do a lot, though not if we go into a recession. That will make it harder because many of them have balanced budget amendments and things that make it very difficult for states to actually engage in counter-cyclical spending. But let's imagine a happy solution for just a second, which is that states can do a lot to enable financing of clean energy and of clean energy industrial policy. I think one of the most exciting things that we've seen in recent years is an increasing number of states that have what are called green banks, which are basically public, sometimes public-private financial institutions that are set up explicitly to invest in clean energy climate solutions, much like an infrastructure bank, but with just a slightly different focus. And that is something that actually the Inflation Reduction Act provided quite a lot of support for through a program called the Greenhouse Gas Reduction Fund, which included awards to networks that included state green banks. There was $20 billion on the line. That's a lot of dough to go to these kinds of projects that enable sort of investments in things that the private market is less interested in investing in, either because the return on investment isn't high enough, the risk is a little too high for their taste, or just because the dollar amount is too low. And that includes a lot of things in housing energy efficiency, in community solar, in all of these kinds of projects that can deliver enormous benefits to people, but where there are some real market failures. Spoiler alert, that funding is currently caught up in litigation because despite not only having a signed contract, but actually dispersing the funds to a financial intermediary, the Trump administration is trying to claw it back. So that will, once again, further complicate the picture. But there are, I think, a lot of opportunities for states to invest in these kinds of projects that the private sector, for any number of reasons, is going to leave on the sidelines. But again, big asterisk, elephant. Imagine him parked right over there. That anything that we say could be absolute nonsense in about a week's time,
or maybe even a day. Peter, do you want to talk a little bit about the scale of things that states and local governments can help with?
Yeah, I mean, I think it's right. They're going to be able to help, move the needle, but largely for projects, again, that are proven technologies and are economic today or very close. So, things like renewable portfolio standards, those will be helpful as we bring more green generation on in various states. Things around regulations for EV charging, emissions regulations, permitting to get those sites built. Those are investments that largely today stand on their own. Where I think the funding will fall short is for the large moonshot projects. Those won't be funded. The green hydrogen hubs or some sort of new, technology that really needs large-scale government support.
Great. And Tate?
But clearly you didn't read the EO from yesterday because now the EO from yesterday is attacking state-level policy initiatives. So we have a little bit, but before, sorry, I didn't mean to present it that way. But before we get into this, I think the other thing to note, so yes, now the administration's getting smarter and doing things like the EO that was released last night, essentially attacking state-level policies and initiatives for climate. However, in addition to that, I think it's important to note that we did this already. This is exactly what happened in 2016. Everybody moved from the federal government to the state level governments, and it didn't work. It didn't create the infrastructure and the economical gains in the U.S. that a lot of folks were anticipating it would, and that's exactly how we ended up with huge legislation like Bill and IRA. It really went from one aspect of another in those gaps. So I think it's just important to note that, yes, there are opportunities, even with, and the statement on the market now is that hopefully the GGRF funds will be able to get through litigation and will be able to start moving forward to funding. But we have to note that it is very fragmented and there are gaps that only the federal government can fill, really along the supply chain too, because it's harder for the companies. When you go to a state level green bank, a company like I represent that might get a $300 or $400 million DOE loan would have to go to 5 or 6 green banks to fill that gap, and then it creates a burden on the company and the commercialization. So even when you find the money, even without tariffs, even without everything, it was challenging and it proved to be that way.
Great. So let's shift gears just a little bit to something that the current administration might actually favor, like permitting and NEPA reform, so National Environmental Policy Act reform. So Nat, do you want to talk a little bit about how permitting and NEPA reform fit into the whole industrial policy landscape?
Yeah, sure. So again, for the sort of uninitiated, this is about the processes at the federal government, and there are also processes at state and local government, which means it's a really snarled mess. But for process state the government, at the federal level, for permitting new infrastructure projects, new siting of new clean energy facilities, et cetera. So if you think about what is it going to take to meet the growing load demand that we're going to talk about later that folks will talk about later in the afternoon, what does it take to be able to invest on the back of the grants and the tax credits we've been talking about? We also need to build a lot of clean energy infrastructure in this country. We need transmission lines so you can connect solar and wind to the places where the demand is. We need facility siting for clean energy manufacturing sites, for carbon capture. Maybe more controversially, I would argue we want pipelines for carbon dioxide. We heard that in the earlier discussion with Jeff and Vijay. So there's a lot you need to build. I'm sure, I don't know, at least in DC, if we were having this conversation, 80% of the room would already have read Ezra Klein and Derek Thompson's new book, Abundance. I don't know if anybody has read that here, but I managed to read that on Sunday. So this is like a spirit of a thing. We need to build more. Traditionally, that's been on the right, that folks have said we need to cut red tape and do less permitting reform. Now I think you're starting to see that on the kind of center left. So there is a political constituency for making it easier to build energy infrastructure generally. And you can imagine what the outlines of that are going to be, because traditionally Republicans have said, well, we want to cut red tape, make it easier to build, and by the way, we want to build more kind of oil and gas energy infrastructure, and Democrats have said, well, we want more transmission, we want more clean energy stuff. So you can see the outlines for a political deal. We got pretty far, actually, last year, closer than I think folks, especially after the election, we thought we might not get anywhere, and almost got there, but here's what the problem was. On the House side, the Speaker Johnson, I think, didn't see the political reason to get it done in that year. But the bigger problem, frankly, was, I think, on the Democratic side, on the left, and many of my friends in the environmental community, concerns around, well, what does this mean for National Economic Policy Act reform, for NEPA reform? What does it mean for our ability to challenge projects? So here's my take, because I've described the politics. On the substance, I would just say sort of 2 points. One, and they both boil down to, I'm an environmentalist. I've spent a lot of time in the environmental organizations. I think we need to get over that concern and just go and make a deal on permitting reform for 2 reasons. One, the economics, everything we've talked about in terms of tariffs and so on, notwithstanding right now, still, the direction of travel on the economics of clean energy is much better than the direction of travel on the economics of fossil. And so if you make it much easier to build all energy infrastructure right now, I'm willing to make the bet that that's going to mostly yield more clean energy infrastructure. So that's the first point. Yes, we might see some more natural gas pipelines, for example, but we're going to see much more in the way of clean energy infrastructure. And number 2, if what you're worried about is a fossil fuel heavy energy infrastructure, guess what? That's what we have today. Congratulations. We already have a fossil heavy energy infrastructure, and making it easier to build more stuff does not mean that's what we're going to get. I think we're going to move towards clean energy. So I think we need to really open that up, and that's going to mean, going against that sort of the sacred cow on the left of NEPA reform. There are smart ways to do that. People who are smarter than me on that can talk about it, but we're going to have to get there if we want to open up the kind of investment floodgates overall for all we've been talking about in terms of investing in clean energy.
Great. Tate, do you want to add anything?
Yeah, I mean, I think what I'll say on NEPA reform and the way it impacts these projects is, and what's coming down the pike is, it is coming. I do feel hopefully we'll get to a deal on permitting, but NEPA reform is absolutely coming. But it's going to take a while still. So even we have projects that we just anticipate for the next year or 2 will still be hung up in this quagmire. I will say just in the past 2 weeks, we've had folks from the agency start to talk about it where they were in denial about it, probably even a month ago after things started to get released. So that is a positive sign in the right direction, but the thing we haven't talked about yet is the agencies and going through cuts as a result of DOGE, and that is happening right now. So how do we go through significant reform when we don't have a sufficient personnel to implement? So that is why, even though it could start to happen sooner, my view is that it really will take some time.
Great, thanks. So we heard a lot this morning about AI and the load growth, electrification, advanced manufacturing. How do we think that all of that load growth affects or shapes the discourse on policies? And this may also be a 2 weeks ago versus right now kind of moment. But Peter, we'll start with you.
Yeah, I mean, I think there's going to be the reality of the situation and the power needs versus maybe what the administration would like to do with the energy that's being produced on the grid. And so, again, and we've talked about this in a number of sessions, and particularly the previous session, but if you just look at the power grid today, for the first time, load growth is growing in the last 25 years. And by 2050, it's expected to increase by 50%. You know, we've never had that before. And it's driven by all of these things. And the real need, particularly around data centers and AI, is today, and it's really through 2030. And the only way that you're going to be able to serve that is really, you know, the quickest, cheapest way is through batteries, some renewables, and both front of meter and behind the meter, and then demand side management. These are the things that are available to us today. So yes, people may want more gas generation, but the reality of it is, if you can even get the turbines, GE Vernova said they're not increasing their turbine production, they're just gonna raise prices, they're booked out till 2030. Even if you could get the turbines, it's gonna take you 4 to 7 years to build a new CCGT. You're just not going to meet that energy demand. So if you wanna grow the economy and you wanna grow these industries, you're gonna have to meet it with whatever's available.
Great. Kristina?
Yeah, so just building on what Peter just said and sort of lessons learned also from Inflation Reduction Act implementation, you know, not only are the turbines not available for at least the next 5 years, if you do not have an NGCC plant planned already and in the queue and your turbines purchased, you are not building one for the next 5 years. But you might also still not want to build one after the next 5 years because a number of utility executives who own and operate a mix of resources have recently been out saying, you know, the cost of capital, the cost of labor for building an NGCC plant has actually increased 50, 75% since the last time we did this at scale. And again, you're in this era of all of this uncertainty. It's going to be actually very, very hard right now for them to even plan for 2030 and beyond for these very, you know, CapEx intensive, labor intensive assets to be built and put on the grid. And this is the major thing if you want to have an industrial policy of really any kind. I mean, you know, we kind of used to joke that the IRA was the all carrots approach to industrial policy, and I guess this administration is trying to do the all sticks approach to industrial policy. But either way, what you need is some level of certainty and in an actual reality-based timeline for how long it takes to actually build things and put them in service, leaving aside any sort of permitting questions. You cannot just snap your fingers overnight and say, congratulations, suddenly we're going to you know, have unicorns lick into existence a bunch of natural gas turbines that we weren't previously going to build. And the same thing is true on the renewable side. Everything that is in the queue right now, like 80, 90% of what is in the queue right now to be added to the grid over the next 5 years are renewables. And anything that increases the price of putting those renewables on is going to be bad for business and bad for the data centers and the hyperscalers and bad for consumers as well, by the way. And anything that creates uncertainty for whether those projects will actually be able to get permitted and built, which, by the way, for all their talk about wanting to engage in permitting reform, the administration has frozen permitting on public lands and waters of renewables projects, both wind and solar. They have taken other steps to actually make it harder for wind and solar and battery projects to get connected to the grid. All of that is just bad news for energy costs, it's bad news for consumers, it's bad news for business certainty, it's bad news for industrial policy, full stop.
So Nat, how does this tie into the things you were just talking about, permit reform and the support for the tax credits in the IRA?
Yeah, so I mean, 3 quick points. First, I'll just make an observation. So I'm on the board of the Electric Power Research Institute and have been for a year and a half. And just in that period of time, the conversation, so that's mostly electric utility CEOs, and the conversation has changed completely. So I think at the first board meeting I was at, was probably second half of 2023, we were still in the world of flat demand going forward and, you know, sort of a boring, you know, how are you going to think about sort of managing that flat demand? And then almost overnight, all the conversation was around AI, energy demand growth, and Peter spoke to it. And so I think it really has been a very radical shift and a really a very, very quick one. And I know that same thing is happening in sort of regulatory policy areas and so on. The second point, just on the IRA and tax credit defense, I mean, I think it's clearly, and the permitting reform, if you want to build out, as Kristina was saying, if you really want to build out the kind of clean energy infrastructure we need to meet that growing demand, you definitely need to make it easier to build transmission. That's a core part of the permitting reform piece. You would want to be supporting clean energy investment of all kind, and that's the IRA. And so pulling this, the permitting reform remains critical. Protecting those core clean electricity generation tax credits I was talking about also remains critical. But again, then the third point, like that's all as of 2 weeks ago. And the most important thing, and I think if you're thinking about how to induce long-term investment, as David said, it's the policy, and it's a policy certainty, it's a policy environment. And I think this administration, this is maybe one of the clearest places where the clearly stated goal of this administration, which is AI, sort of to have the U.S. be a dominant player in AI, is just squarely opposed by what they are doing in terms of their policies, right? We can argue about clean energy because I don't think this White House shares my priorities on clean energy, so maybe it's, to them, they're not worried about that. But AI is something that this administration has said is a top priority. You cannot meet the goals of scaling up AI capacity in this country if you prevent folks or make it much, much more uneconomical and expensive to build clean energy or any kind of energy.
So quickly, cognizant of time, Tate, we're dusting off 3 Mile Island nuclear plant. There's talk about, bringing in other forms. We've spent a lot of time thinking about solar, wind versus fossils, but there's potentially hydrogen, there's nuclear, there's utility scale geothermal. Any sense that these will actually be able to help us meet this increased demand in a timely fashion?
Yeah, and again, we're kind of going back to where we left in 2019 with the Trump administration. And quickly, what I'll just say is it's funny how we thought we'd go right back. We have DOGE now getting in the middle of everything, which will make it hard to execute. But in some ways, we are going back to where we were, which was further along than when we started in 2016 on a lot of the technologies you just mentioned, plus critical minerals, plus US manufacturing. So we still see a clear nexus on that moving forward in the clean energy space. Now somebody needs to buy the products for the manufacturing, right? So we have that issue, but we still do see support for that in the administration and expect that to continue, of course, but then we have all I like to call them the bumps in the road, because we're getting bumpier every day with tariffs and DOGE and everything, but we do see that pick up in areas that everyone can agree on. However, what happens remains to be seen.
Yeah, thank you. So we've been focusing thus far on the panel on industrial policy, either how it was or how it is at the moment. But let's take a step back for a minute, and I want to ask the panel, how should we be thinking about industrial policy going forward? What parts of the clean energy supply chain do we want to have manufactured in the United States? What parts might be best elsewhere, and how do we get there? And Nat, I'm going to let you kick that one off.
Yeah, I'll try to be brief. I'm an economist like Lori, so I bring in a sort of certain bias, but I think, I guess 2 points to make. The first is, I think it's very healthy that we've moved through the kind of should we or should we not have anything that we label industrial policy. That was a debate, I think, that has raged certainly within sort of the center left and the left of the Democratic Party, and but also I think throughout the policy conversation. I think it's good that we've moved through that to say, look, and I think Kristina laid it out at the beginning very well. There are areas that we think are going to be critical to the U.S. economy, to U.S. competitiveness, and to things, to the global future, where government investment to boost that is going to be important. We don't want to just leave it up to markets. And so I think that's really important. But then that leads to the second point. So we've gotten past the sort of name calling, like, no, that's industrial policy. We can never do that. Didn't you hear about the Synfuels Corporation and the Carter administration? I think the challenge is that what we haven't gotten to, and maybe this is the next step, is so what's the limiting principle to that? Because it can't also be the case that everything we produce, we want to produce in the U.S. By the way, if that's what you thought going in, well, guess what? Good luck. That's where we're headed with the Trump tariffs. Like, that is an attempt to have everything we produce in the U.S., and I don't think that's going to work economically. So even when we're thinking about kind of industrial policy for the clean energy boom or the clean energy economy, advanced energy future, I think we need to think, and this I think is a work in progress, what is the limiting principle that tells us here are the things, here's where government should invest? How would we know, how would we iterate on that to learn because maybe we don't get it right the first time. So how do we iterate? What do policies look like where you have a portfolio of things, you have metrics to understand where to invest? Just to give you a sense of the spectrum, this is where I'll put my cards on the table. Solar panels, there is no way, there's no way the US should be trying to build a major US industry in PV wafer solar panels. It's an old technology. Sure, we invented it a long time ago, but the Chinese scaled it. And if we want to build cheap solar in this country, the last thing we should do is try to build the supply chain all in the US. So we should just give that up. We should say that's gone, that's in China. But the auto manufacturing industry, like that is to play for right now. And if we don't have policies in place, I think we will lose electric vehicles to China. That's already starting to happen. And that, I think, would be a real problem because the automotive industry is the backbone of so many supply chains in the US. And the political economy of losing the auto industry would pretty much ensure that we could never do anything on climate and energy again. So there's a political and a policy piece here. That, to me, those are like two poles of the spectrum. I'm interested in like where do we draw the line?
Great. Tate, you want to go next?
So I mean, my whole career, about 20 years now, has just been a ping pong, right, of back and forth. And really where we need to go is we need folks to come to the middle, develop and agree upon the middle versus going through these crazy swings that we've gone through. And I know I'm oversimplifying an incredibly complex topic that we all deal with, but I'm hopeful that there will, and I think the only good thing about the tariffs this week, I will say, is we're starting to finally see more Republicans speak up and say, how are we going to do this moving forward? What are we really going to do moving forward? So I think hoping to find a middle ground out of this and we do have a lot of moderate members of Congress that will come together, but what I would like to see if I lived in an ideal dream world would be a bipartisan policy for industrial policy that we can at least get both sides to agree on and stop these swings back and forth.
Peter, I have to imagine you agree with that, right? Like,
Yeah.
we just need some certainty.
Yeah, I mean, I think, and we were actually talking about this the other day on our prep session, like you can underwrite stable bad policy. You can factor that into your analysis, so you can invest behind it. It's the variability that's so hard to sign up for.
Great. And you worked, Kristina, on the Biden industrial policy. What do you think you got right? And is there anything that you think should be different?
Sure. So, I mean, I think what we learned are a couple of important things that folks should keep in mind for whatever the next phase of anything approaching a rational industrial policy looks like. One is that there are really important places where transparent, predictable, known incentives can spur a lot of private sector investment. And those are, largely in places where you are talking, and particularly for production of those things. There's sort of a big delta. There's two main kinds of ways that you can do these tax incentives. You can have a production tax credit for actually making the stuff, or you can have an investment tax credit that helps underwrite, that helps subsidize the upfront investment in a facility. If you have a mature technology, if you have a relatively mature technology where you're just trying, we need more of this in the United States, we need to increase market share, we need to encourage more of this, a production tax credit works extremely well. We saw this with clean energy manufacturing. Where it doesn't work as well is where either you have a relatively immature technology or one with very high upfront CapEx costs, because then you are exposed to these other macroeconomic factors that are out that can quickly overwhelm the ability of the production tax credit to actually provide sort of that transparent, predictable, known level of subsidy, and then your investments start to have a lot of problems. And so we saw that, I would say, with the hydrogen production tax credit, which I spent a truly exhausting amount of time on, where companies had made a lot of plans in sort of a 2020, 2021 interest rate environment. And then in 2023 and 2024, when we are actually doing the guidance, the level of incentive that Congress had assigned was basically no longer sufficient to contend with the interest rate environment. You also see that same kind of dynamic playing out in areas of the industrial supply chain where usually China had a hyper-concentrated market advantage, and they could just look at what our subsidy was and say, great, I'll go ahead and undercut that now. And so you need some kind of more flexible financing tool to help deal with that hyper-concentration if you want to ultimately break up that supply chain or de-risk that supply chain at all.
So I think you just answered what was going to be the lightning round question before I get the 1 minute mark, which is, if you could recommend one transformative policy intervention to address carbon emissions, what would it be? Quickly. Each person gets 15 seconds.
I mashed it up, so now
Okay,
you have
go ahead, Nath.
So it's not enough to build clean energy. We need to retire old fossil polluting. And so we need to pair the industrial policies we have with, it's going to sound like Back to the Future, a cap on carbon pollution. We need to emit less, and we'll figure out a way to get back, or we won't solve the problem.
Tate?
So I covered it a little bit before, but I'll say again, just bipartisan industrial policy that, and I do think what I will say is the Infrastructure Act was a lot of pieces from the original Trump administration. So maybe we'll see that at the end and then can go from there.
All right, Peter, bring us home.
Yeah, I mean, look, from billions to trillions, 7 trillion to 9 trillion, depending on the study you read, is required every year to get to net zero. You're not going to do that with government capital. You have to bring in private capital, and private capital has to earn a return. And so the way to do that, one, is with consistent policy, which Tate touched on, but really the one would be, and it's a play on Nats, would be a carbon tax, right? It's technology neutral, and it incentivizes the market to solve the problem.
Yeah, you can tell who are the economists on the panel. Anyway, it's all great. I have enjoyed this so much. I've learned so much from the four of you, and I hope everyone else has as well. But join me in thanking our amazing panelists.